In today's episode, we are going to be talking about how to pay less taxes as a real estate agent in California. We're going to be going over different deductions. We're going to be going over, is it better to be self-employed or be a corporation? If a corporation, what type of corporation? We're going to talk about different write-offs. For example, how to be able to write off your life. And we'll get into more details. We'll talk about clothes, cars, trips. We'll talk about writing off pools for clients. We'll talk about home office expenses, Augusta rules. We'll talk about real estate professional status. And then also the most important one, buying rentals as well too. To help us with that, we have Barbara Schreihans. I think I pronounced it correctly. She is your tax coach. Welcome to the show. Barbara, how are you?
Hi, thanks for having me.
Of course, I'm excited about this topic. I actually ended up hiring a tax coach very early on in my career, and I witnessed that a lot of real estate agents did not do that, and they got into tax problems very early on in their careers. They got into payment plans, so I think that this is a very important topic. What I also like about it is I think that this topic can transition well to other fields. So if you're a business owner, this is a video that you also want to watch because there's a lot of similarities. If you're self-employed and have a side hustle, this could also transition to that. So let's jump right into it. Is it better to be self-employed or a corporation as a real estate agent?
So if you're just self-employed, like sole proprietor or LLC, you're going to be paying the most amount of money in taxes because there's this hidden little thing on your tax return. It's called other taxes. It's where it's hidden. And if you looked at that line called other taxes on your return, there's probably a really big number on there because the IRS doesn't actually want you to know what that is, but what it is usually is self-employment tax if you're a sole prop or LLC. So what we like to see is once you're making about $40,000 a year in profit, to switch over to an S corporation because S corps can save you up to 15.3% in taxes. That number goes up every year. So even on 100K of income, you're saving over 15 grand in taxes for the same basically business as your friend that's just a sole prop.
Now, what comes along? Because I did that transition and I heard the same exact thing. Like once you start making around 100K, it's better to go into like an S corporation. What is the difference? Like, what are the requirement difference? Because I know it makes things a little bit more complex, basically, meaning like putting yourself on payroll. Can you elaborate a little bit more on that?
Yeah, exactly. So once you're an S Corp, you have to be paid what's called a reasonable compensation. So you're now paid in two different ways from your business. One is through distributions, just like you've been doing with your sole prop or LLC. You know, you just transfer money from your business account to your personal account when you need it. That's called a distribution. Now, the second way you get paid is through payroll, W-2. So you have to pay yourself a reasonable wage. Now, what that is, the IRS won't tell us what that calculation is. It's so weird. But we do have a software that calculates it for you based on like the number of years of experience, where you're living and working, and a whole bunch of other things. So really the big thing is pay yourself reasonable comp. A lot of people switch to S Corps and make the mistake of not putting themselves on payroll, and you can actually get a fine of $25,000 per year for not doing that. So it's super important. The other requirement is that you have to have at least an annual board meeting. But I love that requirement because I can travel to, let's say, Paris and have my annual board meeting there. And that's my reason for traveling to Paris. So you can have your board meetings in cool places. You can have friends and family be a part of your board. So now you have friends, family, kids travel with you, and it's also a business expense. So I actually really like that rule. Some people think of it as like, oh God, I have to like, write meeting minutes, blah, blah, blah. AI can like write meeting minutes for you now. So it's super easy.
That's so cool. How, it's funny that you mentioned have certain family members be a part of your board, which now makes it good as well too. Let's talk about like, so whenever I got the tax advice very early on, I think I had a SEP retirement account, and I think that amount that I can contribute was higher than when I went into an S corporation, which I think at that point I got a 401k from my because I think at that point I had employees. Can you walk us through different retirement vehicles that can also help in terms of like lowering the amount of money that you pay in taxes as well too?
Yeah. So my favorite retirement account is a Roth. Now, that's not going to save you this year in taxes, but it can save you millions of dollars later down the road in retirement. So, um, for example, a Roth, the max contribution this year is 7,000. So the limit's not that high. But if you put $7,000 a year away and it's growing tax free and you get to take it out later in life tax free, if you start when you're 30, you're going to save over $2 million in taxes. So I love it for a long term strategy. Now, if you're wanting to lower your taxes this year, I hate SEPs. You mentioned a SEP. I really don't like them. I think whoever recommends them, like those financial advisors, are lazy. They're the least amount of paperwork, but you can get more money in faster with something like a solo 401k. But I also don't like SEPs because you cannot borrow against them, which if you're in real estate or you're a real estate investor, leverage, we love leverage, right? So I want to be able to leverage my retirement account. You can't do that with a SEP. SEPs are also not protected if you were to ever be sued, and solo 401ks are a little more protected. So there's a lot of reasons why I don't like SEPs. So I would try to go as soon as you can into a solo 401k. Now, you can only do a solo if, like it sounds, you're a solo entrepreneur. You can't have other full-time employees. So like you mentioned, you then got a regular 401k, like a safe harbor 401k, and I love those. As long as there's certain things in place for a safe harbor 401k, you can put up to $69,000 a year away into it. So you can get a huge amount of money into it. And a little known fact, you can make a Roth component to that 401k so that now instead of a $7,000 Roth limit, it's now $23,000. So I love adding a Roth component to a safe harbor 401k.
Let me ask you this, because I was told not too long ago that the max you can put on I think it was a safe harbor, was like $20,000 to $23,000. Am I misunderstanding the 60 some thousand dollars? Because the reason I even thought about the SEP, I'm like, man, like for somebody self-employed, not making over $100,000 a year, they told me that you can write off or put in there about $60,000 in that. So can we talk about the solo 401k? Is it similar to that? And if you have employees, can you put up to $60,000, just to kind of clarify?
Yeah. So a SEP, I also don't like it because the contribution amount that you can put in is based on profit, right? And our job as really good tax strategists is to lower your profit. So if we lower your profit enough, you're going to be limited on how much you can put away into your SEP. So can you put 60K into a SEP? Yeah, but your profit has to be over 250K, which we don't like that because then you're paying a lot of money in taxes.
And self-employment as well too, because in order to have a SEP, do you have to be self-employed, or can you have a SEP and be a corporation like an S corp?
You can have an S corp and have a SEP as well.
I didn't know that.
Yeah. The calculation is different, but you can still have one. For a solo 401k or a safe harbor 401k, you can still get up to $69,000 a year, as long as when they set your plan up, they set up a profit sharing plan with it. So yes, the limit's 23K as your employee contribution because you're an employee of your business, but the employer contribution is then up to the 69,000. So it could be that whoever put the plan in place didn't add the profit sharing.
I love it. I love it. So let's get into like how to write off your life. What does that even mean?
Yeah, I think the best part of owning a business is being able to write off your life. Like most of what we spend money on day to day involves our business in some way, shape, or form, helps grow our business, grow our network, and in turn, make more revenue for us. So there's a lot of things you're probably spending money on every single day that either an accountant before has told you can't write it off, or you just think like you can't write it off, or some people even think like, oh, I have too much in meals deduction, so I'm not going to put all of it on my business expenses. But it's like, take the deductions you're entitled to. That is why the Internal Revenue Code was written the way it was written. Like there's 7,000 pages of the Internal Revenue Code. Only 12 of them tell you how to pay taxes. The rest tell you how to get out of paying taxes. So, that just tells you you're supposed to be writing these things off.
I love it. I love it. So let's talk about meals. Can you write off all meals? What are the requirements to write off meals?
You can probably write off 90% of when you go out to eat. Same with travel, probably 90% of the time you travel as well. But with meals and travel, but your intention before going has to be business related. So like before you even go somewhere, what's your intention? And there's so many different ways to make it a business meal. Like are you networking with someone? Like say you and I go out to lunch. Well, we're not in the same industry, but you and I can talk about business. Anyone can be my client because everyone needs a tax return. So as long as I talk to you about taxes, that
Hmm.
can be a business meal. Same if
For
you're an
real estate.
agent.
Yeah.
Yeah, same if you're an agent, anyone can buy or sell a house. So like talk to them about the market and what it looks like to buy or sell a house. Then it can be a business expense. But also, you know, it could be like maybe meals when you're out at an event or a conference. It's a marketing meeting. You're creating content while you're there. You are taking a contractor out to lunch, an employee, a vendor. Like there's so many ways to make it a business reason. And then once you are there and you have a business reason, just make sure you're keeping the receipt and documenting it so that you have
So I've
the
heard mixed
document.
things about keeping the receipt. So I've heard things like, oh, you don't have to keep the receipt. And I've heard things like you do. I take pictures of every receipt whenever I go out to meals just because I
Yep.
don't want to lose it and I don't want it to fade away. What is the right answer to that?
You are correct. You should be taking pictures of all your receipts. Um, it's funny. Everyone always says, "Oh, some people tell me I have to keep receipts, and some people tell me I don't." But it's like the IRS website tells you to keep them, so keep them.
Yeah.
Anything under $75, you have to have a receipt for, or anything over $75, you have to have a receipt for, technically. But like,
Oh,
I'm
really?
not looking at the receipt if it's under or over $75. I just keep everything. And I do try to scan it right away, like you're saying, because that like magic ink just disappears. You know, if you keep a
Hmm.
receipt in your car and it's a hot day, the ink's going to go away. So keep every receipt, scan them in somewhere like keep track of them. I love the QuickBooks Online app because the app has like a receipt scanning feature and it'll tie it directly to that transaction. So like if you bought something for $17.50, it will find that transaction in your bank feed for $17.50 and tie it together. So it's a lot less work for your bookkeepers too.
I love it. So let's talk about like bank accounts. So like one of the best advice that I got very early on was to have certain bank accounts for certain reasons. What are your thoughts on having like a bank account for like just obviously the business so that all the expenses come out of the business and then having a
Mhm.
personal bank account at the very minimum. And then if you start owning rental properties as well too, we had like different bank accounts just to make that process easier. What do you
Mhm.
typically recommend to your clients?
Yeah, so the IRS hates something that's called commingling. Commingling is like you put all your business and personal stuff in your personal account or vice versa, like you put it all in your business. Because then if you're audited, they can't track like what is actually personal and what is business. So keep everything as separate as you can. Personal stuff is in your personal account, business is in business. And to your point of if you get rental properties, you're going to want to have a bank account per LLC that you have
Hmm.
because again, they want to keep all those income and expenses for that property or that LLC in the right place and it keeps it a lot easier to track. Now, I don't like the profit first method if you've ever heard of that.
I have.
It's like a method where you have like 12 different business accounts for one business and I'm like that's just too much. It's too much. Maybe you have like a business regular account and then a business savings because you need to save for your taxes. Like I think two accounts is fine, maybe three, but beyond that I think it's a little overkill.
Well, I also think that I don't follow the profit first method, and I think that a lot of the people who follow that method at some point had trouble budgeting for taxes or making that tax payment. So, if you
Mhm.
live below your means and don't spend more than what you should, I think that the taxes, even at the end of the year, I try to keep the money as long as I possibly can in my pocket because I know I can invest it or just do is more things with that
Yeah.
money. But us keep going down that ladder. So we talked about meals. Now I've
Mhm.
heard mixed things about clothes as well too. Like I would love to be able to write off business suits. Can I do that?
Maybe. So you can write off clothes if and only if you only ever use them for content or photo shoots. So every quarter we have a huge photo shoot. I need like 8 outfits for that photo shoot. And I can write the clothing off for that photo shoot, but I can't then otherwise wear it personally. So I'll make sure I only wear those 8 outfits if I'm going to be creating content with it, like putting stories on Instagram or creating another video with it, or I record a podcast in that same outfit. So like if you did want a like custom business suit or something, take a photo shoot with you in it and then only wear it to like business meetings, business meals, creating content, which is probably pretty easy. Like, because you're probably going to
Yeah.
want to wear a custom suit to a nice place for dinner. Well, just make sure it's a business dinner and then you're fine.
Then you're good, basically. Yeah,
Or
because
you put
I've
your
heard,
logo all over it, but I don't know if you want your logo all over a custom suit.
I've also heard things like if it's a company uniform or something like that. What does that
Mm-hmm.
mean?
Yeah, it would have to be like in your operating agreement and employment contracts that your employees have to wear a certain thing, right? But you can't discriminate. Like you can't be like, all right, Jose can wear custom suits, and then my employees don't have any other uniform, and I'm
Yeah.
not going to buy them custom suits. It's more for like medical offices where they're wearing scrubs, or restaurants where they have to wear those like black non-slip shoes, something like that. But I suppose if you did want to implement a, fancy suits only.
How sophisticated is the IRS? Like, meaning, like, are they auditing like social media profiles nowadays?
Yeah, they can for sure.
Talk
So,
about that.
um, there's so much they can see now that it's like, it's a good thing because we can prove a lot of things a lot
Yeah.
easier. Like, oh, I created content with this thing. Well, I can go on my Instagram archived stories and I could find that from 7 years ago, But yeah, they will audit your social media. They'll go to your house and actually see like that square footage of your home office deductions. They'll try to disprove you anyway.
So let's talk about cars.
We have clients that write off millions of dollars a year in vehicles. I think it's a really fun way to get business deductions with the caveat, like, don't buy dumb shit. And if you can't afford it, don't buy it. But if you like cars and you like nice cars, like, why not write them off in the business? That's why you see all these like TikTok videos of people writing off their G-Wagons. And that is like literally the reason why Lamborghini came out with that 6,000 pound SUV,
Yeah.
the Urus, because of tax purposes. Elon Musk has said that's the only reason he created an SUV that was over 6,000 pounds was for the tax code. So the rule for this year, 2024, you can write off 60% of your vehicle if it's over 6,000 pounds. So, for example, you buy a $250,000 G-Wagon and you're making payments on it every month. Maybe you're paying like $2,000 a month. So maybe by the end of the year, because you bought it in June, you paid 12 grand for the car, but you can write off 60% of 250,000. So you're writing off 150K, but you only spent 12, which is pretty cool. But again, you're still out money. Like, money is still money. You're just getting it at a discount. So if you're in the 40% tax bracket, you're getting a 40% discount on the car, but at least it's a business deduction.
So in other words, like, there's other investments that you can do. Like, so if you had a choice between buying a car or buying a piece of property and you don't need the car, the piece of property may be a better write-off for you than the property, where you can still get the 60% depreciation on or you can get the bonus depreciation or whatever, which we can get into details. I love the don't buy dumb shit. I think that should be a shirt. Just by the way, you don't think so? That'd be a cool shirt, like, don't buy dumb shit. Like, I think that'd be pretty funny. Yeah.
I like it.
And then at the bottom, your tax coach.
Yeah.
Right?
For sure. We've done like make taxes great again. We've done like a bunch of different shirts. That would be a good one. Don't buy dumb shit.
I think that'd be the
but
next
really,
one.
like, to your point of getting an investment property, like, get enough properties so that your properties then pay for your dumb shit,
Yeah, exactly. Okay, cool. Now, is there a limit as to how many vehicles? Like let's say I had 2 business cars and I don't have any personal cars. That would raise a red flag if you don't have a personal car, right?
Yeah, you would want to take a percentage of business use versus personal. So I I like to recommend people like keep a beater car as personal. Like I kept a 2013 Prius with 260,000 miles on it forever. I just actually donated it last month because it finally died. But that way, that was our personal car, and then all of our other cars could be business related. But if you can't keep a personal car for whatever reason, let's say you buy the G Wagon and you can use it 80% business, and then the other 20%, you're taking your kids to school or going to the gym or whatever. So then you would just take 80% of the purchase price of that G Wagon, and then you can take 60% of that for the bonus.
It's actually not a bad idea just to keep a beater car. And then that point, it's like, hey, I have the personal car here. These are business vehicles as well, too.
They say do that with phones, too. Like, because you can write off your cell phone bill, but obviously we use it some percent for personal. Yeah. So we've seen where the IRS will just ask, do you have another phone that's personal? So like keep an old like iPhone 5. It doesn't even have to be like turned on, but you can show that this iPhone 5 is personal. So then you can write off 100% of your
the cell phone as well too.
Of your new
Got
phone,
it.
Yeah.
What about vacations? Oh wait, I meant business trips. I'm kidding.
Yeah. Rule number 1, you never go on vacation. You take business trips. Probably one of my favorite write-offs. If you go on my Instagram, actually at your tax coach, you can comment anywhere travel and it'll send you my free travel guide. And because it's just my favorite thing to talk about. But for domestic travel, 50% of the days have to be business related. So let's say we go to Florida for 7 days, 4 of the 7 days have to be business related. But the way there and the way back automatically count because I'm going for business. So really, I just need 2 days to have business reasons. So maybe one day we have a board meeting and the second day we record content. So it's super easy to make a week-long trip business related. For international, it has to be 75% of the days. So like it's a little bit harder. So just make sure that you can relate it to business. It's still not impossible. Like we did a trip to Paris and we were having board meetings. We had exec meetings. We did content shoots. We had professional photographers take our photos, and now we're using all those photos in our travel guide. So have a business purpose. Make sure you document it. Keep it on your calendar, like what you did those days. But I mean, hey, if you can write off a $20,000 trip to Paris, like why not?
I love it. Now, how should somebody be documenting this? Like meaning
So
like,
keep
okay,
all the
like,
receipts.
Receipts. Okay.
Keep the receipts, but then keep everything on your calendar. I mean, everything. So if you're going to Florida for 7 days, mark those 7 days on your calendar, Florida trip. And then at the end of each day, go back into your calendar and write exactly what happened that day that was business related. So maybe you brought a friend on that trip. So that day you had a business meeting with your friend talking about the real estate market. And then day 2, you had a photo shoot. Day 3, you had a board meeting. Day 4, you were networking with other agents. Day 5, whatever. So go back in and actually put the specific topics and things that happened. Because if you're audited 5 years from now, it'll be so easy. You can just print out your calendar and be like, here you go. Here's my business proof.
Got it. Okay, cool. You said something off camera. We said that clients could write off pools. What did you mean by that?
So not a business deduction, but a really cool way that you can write off your pool or a hot tub. Even a lot of people right now, are really into saunas, cold plunges, like all the self-care. Before you buy these things or before you sign a contract to have someone put a pool in or a hot tub in, go see your doctor, a chiropractor. And if you have back pain, let's say, like I have really bad low back pain. I was a competitive weightlifter for a really long time, so I have really bad low back pain. So before we put a pool and a hot tub in our house, I had my chiropractor write a doctor's note that said water therapy would be really good for my low back. And so then once you have the doctor's note, you put the pool in. Let's say it was $150,000 to put that in. That $150K would be a medical expense on my personal return. So now you just turned like more fun, quote unquote, expenses into medical expenses on your return.
And if you've had a history of visiting a chiropractor in the past, that would actually probably help, right? As well, too, because you had that history of visiting. If you have a history of like acupuncture or just things that would help support that would probably help. I love it.
Yep.
Okay.
History for sure, but definitely get the note.
Home offices.
Yeah, I think probably everyone has a home office these days, and nobody is maximizing them out on their returns. Like, I never see prospects' tax returns where an accountant is maxing it out. They take the lazy way, which is called the simplified method, but they should be taking the actual, which is when you can take a percentage of your mortgage interest, your property taxes, your insurance, every single utility that you have. If you have a cleaner, a pool person, a landscaper, security system, pest control, like there are so many expenses in relation to our houses these days. You can take a percentage of those and take that as an expense on your business return. Or if you're an S Corp, it's called a reimbursement. So you can take it still on an S Corp return. But then we also try to work with our clients to expand their home office square footage, because the more square footage you have, the bigger expense it will be. So can we designate a bathroom where that bathroom is only used for business, like home office? Maybe it's something with an ensuite, or maybe a lot of people don't think about this, but if you have a business vehicle, you probably park your business vehicle in your garage. So add that garage square footage to your home office deduction, and then you can get a bigger expense.
Let me ask you this. Like, let's say you had a home that was 2,600 square feet and you had a 1,200 square foot separate office. What percentage of the mortgage taxes interest could you write off?
So you'd probably have 3,800
square feet. Yeah, correct. Yeah.
Yeah. So you would take 1,200 out of 3,800 for home
So,
office. Or
so meaning
if
it
you
would be like 33% of that you could potentially write off, because it's almost like a third almost.
Yeah.
Which that would be
That'd
great.
be huge. Yeah. Plus, if it's a separate building, you could take the depreciation on it as well. And then make sure you're taking everything that's in that 1,200 square feet as a deduction. So, like, people forget all the time, like, you probably have plants in there, or flowers, candles, artwork. All of that can be a business deduction because it's in your home office.
If you were to build it out, you could write it off as well too, meaning like you could pay money to build out like offices. The reason I ask is I just bought a home and it's got like a separate 1,200 square foot unit, and we're making all of it into like a private office as well too.
Yeah.
It's got its own separate entrance. It's like, it's sweet.
Yeah, so it's super popular for California ADUs. You can also register a separate address for them as well. So you can just go to the post office website and register it as like a half address, or AB, like if you want your house as A and the little ADU as a B. And then your business could even like pay rent to you as, because you own the separate building. There's like a lot of different things you can do with it. And it just more legitimizes it when it's a separate address.
Got it. You said that tax professionals usually take the lazy route. What's the other route of doing it versus a percentage?
Oh, the simplified method. So the
max,
the max for simplified is $1,500 a year. So it's not that much. Typically, when you're taking the actual method, our clients are getting like $5,000, $10,000 or more as a home office deduction.
Got it. Okay, so let's talk about, like, some agents do this, not all agents do this, but buying rental properties. Is there a benefit to real estate agents buying rental properties? If so, what is it? And then what are some advanced strategies, like maybe like real estate professional status, cost segregation studies?
Yeah, love it. So you as real estate agents have kind of this upper hand in being able to take deductions on rental properties, because non-real estate professionals are limited to the losses that they can take on rental properties. So like if I make over 150 a year, I can no longer take rental losses against my active income or W-2 income. But when you're a real estate professional, which doesn't just mean agent, there's actually 11 different industries where you can qualify for the hours requirement. But let's say for agents, you probably spend more than 750 hours a year in real estate, because that's only about 15 hours a week. But that's the first hurdle. You have to spend 750 hours in real estate. And then you have to materially participate, which means, let's say you have one property. The most common way to hit material participation is to spend 100 hours on your rental property and more than anyone else. So maybe you go there and check on it every month and you collect the rent and you're interviewing the tenants and you have to mow the lawn and you make repairs on the property, you can easily get to 100 hours. Make sure you're tracking your hours on it. But as long as you hit those two things, then we can do what's called a cost segregation study. And you have to have a CPA or an engineering firm sign off on these. We do them in our firm. And it will accelerate your depreciation, kind of like with the car, right? Where you can take like 60% of the car instead of over 5 years. We can do the same in real estate where we accelerate your depreciation. And now let's say like you bought a $250,000 house, we could probably get you $50,000 to $75,000 in deductions on your return that will offset your real estate agent income. So real estate investing for agents is like so good.
Yeah, it's funny because I got hammered one year in taxes, and I read a book. It was called Loopholes, Real Estate Tax Loopholes, or something like that. And I found out about cost segregation. After that, I bought a 25-unit apartment, and I couldn't believe I got $1 million tax write off on year one with the bonus depreciation, which means I got to write off the next $1 million of my real estate income. Which to me, I was like, why didn't you tell me about this? Like I would have bought a bigger building a long time ago, but I just didn't know about it. But that was like a game changer for us. So if you're a real estate agent and you don't know about cost segregation and you don't know about buying, how rental properties could actually help you out substantially, that would be something to talk to Barbara about. What about tracking expenses? Like, what are some tips there? Or like, are there certain applications? What do you recommend in that sense?
We love QuickBooks Online. It's probably the most commonly used software, but it's so user friendly. But definitely have a bookkeeper that knows tax. There's a difference there. There's a lot of bad bookkeepers out there, but make sure you have a bookkeeper that knows tax, doing your books every single month. But then you, as the agent, have the QuickBooks app on your phone, because then you can scan your receipts easy. Like I was mentioning earlier, it will also track your miles for you for your business vehicles, so that you just swipe left or right for business and personal miles. So I love QuickBooks Online, but also get a bookkeeper, because if your numbers are not accurate and you don't actually know your profit every month, it's really hard for us as your tax strategists to come up with a real tax plan for you, because we don't know if you're profiting 50K or 500K or 5 million. We have a lot of clients that come to us and they think they're profiting a lot, and then we do their books and they have no profit, or vice versa,
Yeah, because a lot of money could come in, but if you have a lot of expenses, that whole whatever's coming in could be going out. So it's very important. Good. Anything else that you think would be helpful for somebody looking to pay less in taxes that are a real estate agent in California?
I would say, first get in a really good habit of keeping your receipts, tracking your expenses, really look into how you're structured. So I talked at the beginning about being an LLC versus an S Corp. I know for a lot of people in California, they hesitate on getting their LLC because of the $800 a year fee, but like $800 in the grand scheme of things to ease your anxiety. And now you have liability protection, because you never know when you're going to get sued. Nobody wants to get sued, but like it happens, especially as an agent. Transactions go awry all the time. So do it, if not for the liability protection and just like peace of mind, so you can sleep a little bit better, because $800 is really nothing. And then do like an audit of your personal expenses. What are you spending money on every single day that you could tie to your business, and take those as business deductions so that you're paying less in taxes? Because if you're paying less in taxes, you have more money for your family. You have more money to invest. You have more money to reinvest back into your business and to build generational wealth. So it's not just about saving taxes. It's like, what do you then do with it,
Well, I think what helped me too is that once I started saving more in taxes, it created this snowball effect where I had all this extra income to be able to make an additional investment. And that additional investment helped me, which gave me more deductions and also helped me have more money for reinvestment. So it creates a snowball effect where the snowball just keeps getting bigger and bigger, and then you start building actual momentum. So I think it's very, very important for real estate agents to basically look at what they're paying in taxes and realize that that could be your largest expense that you're having right now in your business if you don't have the right professional. So if somebody enjoyed this interview and they wanted to get in contact with you, what is the best way for them to do that?
Yeah, go to yourtaxcoach.com or your tax coach on Instagram or really any social media platform. And it's me in the DMs. So if you have any tax questions or you just want to say hi and tell me what you learned in this episode, I'm happy to answer questions. And I just love hanging out with people on Instagram.
I love it. I love it. So I want to say thank you for taking the time to come on the show. To our viewers out there, we talked about how to pay less taxes in real estate as a real estate agent in California. Talked about meals, cars, pools, trips. We talked about home offices. So we gave a little bit about everything. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to another fellow realtor or another fellow business owner, make sure to hit that share button. Thank you again, Barbara, and to our viewers, until next time.